In a webinar on Friday, 21 May, involving Fed Chairman Jay Powell and a previous Deputy Chairman Alan Blinder, Powell used the words, "whatever we can and as long as it takes." Powell repeated this phrase in the opening words of his Fed press conference on 10 June. The saying had echoes of the words of Mario Draghi, "whatever it takes," during the 2013 European sovereign debt crisis. Today, I would like to explore the meaning of what Powell said. In the discussion between Jay Powell and Alan Blinder, Powell said that the Fed was now comfortable using two tools which were previously thought of as unconventional monetary policy. These two tools were forward guidance and quantitative easing. Both of these strategies were on display in the statement by the Federal Reserve of 10 June. The first was forward guidance. The statement read, "The committee decided to maintain the target range for the Fed funds rate of between 0 and 0.25%. The committee expects to maintain this target range until it is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals." The Fed is giving us forward guidance that there will be no change in the Fed funds rate for as long as it takes to solve the current problems of high unemployment and low inflation. The Fed then restated its objective of maximum employment and its symmetric 2% inflation objective. Then the Fed moved to discuss its use of the second aspect of what used to be unconventional monetary policy. This is quantitative easing. The statement reads, "Over coming months, the Federal Reserve will increase its holdings of Treasury and agency, residential and commercial-backed securities, at least at the pace to sustain smooth market functioning, thereby fostering effective transmission of monetary policy to broader financial conditions." First, the Fed is giving us forward guidance that the Fed funds rate will be unchanged for the foreseeable future. Secondly, we are being told that quantitative easing will be used to make sure that the low Fed funds rate guarantees low interest rates in residential and commercial mortgage-backed securities. Since the Fed statement on 10 June, a further statement of 15 June described the extension of quantitative easing to the market in US corporate bonds. This policy was announced back in late March. Since that time, the Fed has constructed a special purpose vehicle, or SPV. The Fed itself cannot take commercial risk, so it lends to an SPV which has a Department of US Treasury equity investment of $75 billion. The purpose of this equity investment is to provide a buffer to absorb any losses should they occur. This ensures that the Fed itself never loses money. The combination of this buffer plus the support by the Fed means that the SPV, the special purpose vehicle, can acquire up to US $750 billion of US corporate debt. The Fed has two credit facilities to support the US corporate debt market. The first is the primary corporate credit facility. This began back on 9 April. This takes up new issues of US corporate bonds. Up to US $500 billion of this program is devoted to this facility. What was announced on 15 June was the secondary market corporate facility. This supports the existing market in US corporate bonds. up to US $250 billion of this program is devoted to the second facility. Under the Secondary Market Corporate Facility Program, the SPV requires, firstly, eligible individual corporate bonds, secondly, eligible corporate bond portfolios in the form of exchange-traded funds, and eligible corporate bond portfolios that track a broad market index. By going through this process, the forward guidance provided by the Fed, together with its quantitative easing, now reaches all the way into the corporate sector through the US corporate debt market. Where will this lead us? For the first time this year, the Federal Reserve release of 10 June was provided together with a summary of economic projections. This provided us with the outlook formed by all the information received by the individual Federal Reserve Bank presidents and all of the members of the Federal Open Market Committee. There is a wide dispersion in all these views amongst Fed institutions that are in the sample. The Fed thinks, and they have a median expectation, that US GDP will fall by 6.5% in calendar 2020. Now we know that US GDP fell by 1.4% in the first quarter, and the most recent estimates of the Atlanta Fed is that US GDP fell by 12.1% in the second quarter. This is a total decline of 13.5%. To recover to the level estimated by the Fed suggests a tremendous growth rate of 7% of US GDP will occur between now and the end of the year. In ordinary times, this would feel like a spectacular acceleration. This is then expected to be followed by a powerful rise of 5% of GDP in 2021 and a strong increase of GDP of 3.5% in 2022. The median estimate for unemployment by the Fed is that it will stand at 9.2% by the end of 2020. This is a sharp drop from the unemployment rate of 13.3% in May 2020. It is no surprise that starting from such an elevated level of unemployment would lead to low inflation. The core consumption deflator is estimated at only 1% in 2020, 1.5% in 2021, and 1.7% in 2022. All of these estimates have a broad range of different expectations by different members of the Fed. The one item in which there appears to be almost no variation of expectations in the future is the Fed funds rate. The Fed members expect that this will be rock solid at a rate of 0.1% in 2020, 2021 and 2022. The Fed will do whatever it can and for as long as it takes. The Fed funds rate will be at the current low level for as far as the Fed can see. The Fed's forward guidance promises this. They now expect to deliver on that promise.